Good morning from Frankfurt. My name is Andreas Glenzel, and I would like to welcome you to this very special edition of Frankfurt Main Finance Food for Thought webinar, as always in cooperation with the Association of International Banks in Germany, and today as a joint event with one of Frankfurt Main Finance's closest partners, the Association for Financial Markets in Europe. AFME is the voice of the leading banks in Europe's financial markets, providing expertise across a broad range of regulatory and capital markets issues. Together, we are focusing on a highly critical topic, from rulebook to reality, preparing for the EU AML framework. We are delighted to see such strong interest in today's discussion. More than 270 participants have registered for this webinar, which demonstrates both the relevance and the urgency of the topic we will discuss today. Our regular guests will notice that we have adjusted the event schedule to a panel format. But before I hand over to our distinguished panel, I would like to briefly address three questions. Why does this topic matter? Why does it matter now? And why are we discussing it together with AFME? So, the 2026 Global Financial Crime Report found that illicit financial activity has surged by $1.3 trillion since 2023, bringing the global financial crime epidemic to an estimated $4.4 trillion. In the European Union, the Council has reported that around 70% of active criminal networks rely on some form of money laundering to finance their activities and conceal proceeds, highlighting the pervasive nature of the problem across member states. Money laundering is not only a crime, but also serves to finance and conceal it. This brings me to the second question, why now? Because Europe's response to this challenge is entering a completely new phase. With the establishment of AMLR, headquartered here in Frankfurt, the European Union has created its first truly integrated anti-money laundering authority. On January 1st this year, the European Banking Authority EBA and the Authority for Anti-Money Laundering and Countering the Financing of Terrorism AMLR completed the transfer of all AML-CFT mandates and functions from the EBA to AMLR, marking a milestone in the EU's fight against financial crime. On June 3rd, AMLR had launched a public consultation on draft guidelines setting out how obliged entities should carry out ongoing monitoring of their business relationships, including the monitoring of transactions and activities. A public hearing on the draft guidelines is scheduled for July 2nd. And only 1 week ago, on June 9th, AMLR hosted its first major conference here in Frankfurt. Why is this date so critical? Because by July 10th of this year, AMLR needs to finalize and submit a massive batch of Europe's new core rules for anti-money laundering. These documents contain exact practical details on things like how financial institutions should continuously monitor customer relationships, identify suspicious activities, update customer information, and apply risk-based controls. Once these rules are handed in, Europe's unified anti-money laundering rules are set. That is exactly why we felt it is important to organize today's discussion together with AFME. Through its committees, working groups, and policy expertise, AFME plays a key role in helping regulators understand operational realities and implementation challenges across the industry. Frankfurt Main Finance and AFME have enjoyed a close and productive partnership for many years. We share a common goal, ensuring that Europe remains both competitive and resilient while maintaining the highest standards of financial integrity. I'm therefore particularly pleased to announce today that this cooperation will continue later this year, with Frankfurt Main Finance supporting the AFME European Anti-Money Laundering Conference 2026 here in Frankfurt this November. But before we look ahead, we have an excellent discussion ahead of us today. We have assembled a distinguished panel representing different perspectives from banking, consulting, compliance, and industry advocacy, and I'm confident that their insights will help us better understand both the opportunities and the challenges of the new European AML framework. With that, it is my pleasure to hand over to Louise Roger, who leads AFME's Compliance Committee and many of AFME's important AML-related initiatives. Louise, thank you again for your partnership and support. The floor is yours.
Andreas, thank you for an excellent introduction. So I will be moderating the panel discussion today, and I would like to introduce you to the panel. So joining us this morning, we have Akash Jain, and Akash is the EU AMLR Programme Lead for Deutsche Bank. We will also be joined by Carsten Lang, and Carsten is the Head of Financial Crime Prevention in Germany, Deputy Group MLRO at UBS. We're also delighted to be joined by Goetz Fischer, who is a partner at KPMG, and in his role, Goetz is the Audit and Advisory Lead on AML, and he also co-heads the European AMLR office, which they have very recently founded. So I think you will all agree we've got an esteemed panel to take us through some of the questions and key topics that we'd like to cover this morning. And my first question will be to Goetz. Now, Goetz, a very helpful overview from Andreas there on why the EU AML package is important and what the sort of role of AMLR will be going forward. I'd like to ask you, Goetz, how do you think, or how does the EU AML package help Europe fight money laundering more effectively and more efficiently?
Louise, pleasure to take the question, and taking into consideration what Andreas alluded to, taking into consideration the three overarching aims, which were the drivers of the whole EU AML package, being consistency in the legal requirements, now being represented in the single rulebook, the AML regulation, consistency in supervisory approaches and scrutiny, now being represented in AMLA as the central direct and indirect supervisory authority, and facilitating the FIU activities cross-border. Having those three drivers, I strongly believe that this consistency will lead on a level playing field to a better coordinated supervision by national competent authorities, with less loopholes on one side and hopefully less gold plating on the other side. A more impactful FIU activity that does not stop at national borders but can better follow the money to where it goes. And not to forget the obliged entities, because two very big players are here. The obliged entities, which do not need to cater any longer for 27 quite heterogeneous rule sets in each member country, but can hopefully establish an efficient AML CTF target operating model, which they then can apply in the whole or in the entire EU. So therefore, I guess there's enough reason to reasonably assume that this will help effectively fighting money laundering.
Goetz, thank you. And a similar or related question for Akash on the panel this morning. So Akash, we often hear single rulebook and harmonization. In practice, where do you expect the greatest reduction in fragmentation? And where do you still expect there to be divergence across approaches taken by member states across the EU?
Louise, thank you first of all for inviting me to the panel. I think the EU AML package is one of the most significant regulatory changes in AML that has probably come in the last more than 2 decades. So I think such conversations are critical for industry as a whole. Now, coming back to your question on the harmonization, I think there are 3 areas where we expect to see tangible reduction in fragmentation. And I think I'll probably echo some of the points that Goetz made. The first is around KYC and customer due diligence standards. So from a Deutsche Bank perspective, today we operate under multiple national frameworks. Obviously, German GWG, BaFin, AUA provides the core, but we obviously operate in many other countries, and we have local addendas for all these other countries, and therefore variations in the requirements. Under AMLR, we now move to a directly applicable regulation with consistent minimum requirements across Europe. So this would provide things like a harmonized review cycle, standardized data fields, aligned expectations on KYC refreshes and triggers. And this is not just a benefit to the banks. This is a benefit to the clients that all the banks work with. So that's the first area. Second one, again, got mentioned it. It's the supervisory convergence that we expect through AMLA. AMLA is not just setting the technical standards via the RTSs and the ITSs, but it will also supervise selected institutions. This will create a more centralized, coordinated supervisory dialogue, which will drive consistency in the interpretation. In the AMLA conference last week, which Andreas mentioned, one of the panelists stated for the very first time, AMLA would be able to create what was termed as an intelligence infrastructure to be a step ahead of the criminals to fight financial crime. This is crucial, especially in the day and age where criminals are looking at technology to be a step ahead of the banks. I think the third area where we'll see harmonization is data and reporting standardization. So we already see this through the data collection exercises that AMLA have conducted. At DB, for example, we have had to submit consistent data sets across all of our European entities. And this is clearly moving towards a standardized EU-wide reporting model, which we wholeheartedly welcome. While this is a great outcome, we should be cautious about overestimating this harmonization. And again, I'll probably take three particular examples or points here. The first one is there still needs to be national transposition elements and local law overlays. Even though AMLR is directly applicable, the broader package still includes AMLD6 and national legislation. So this includes FIU operations, BO registers, which are country specific. There is still some uncertainty on how these elements will be implemented locally, including like the beneficial ownership register and the reporting framework. So in practice, firms will still need to manage this local legal nuance on top of the EU single rulebook. I think the second area we need to be cautious about is the interpretation of these RTSs and guidelines. A key challenge for all of us is the sizable proportion of the framework is still being defined. RTS on group-wide standards, business-wide risk assessments, ongoing monitoring are still being finalized. Now, the approach we are taking is not to wait for these RTSs to be released, but rather make working assumptions through a risk-based approach. And lastly, often underestimated is the operational implementation differences across firms and jurisdictions. Even with harmonized rules, how banks implement concepts like what we Deutsche Bank terms as holistic client view, which we'll probably cover later in this conversation, transaction monitoring thresholds, beneficial ownership calculation can still materially vary. So in summary, I'd say AMLR provides a step change towards harmonization, but in practice, firms should still plan for some level of divergence driven by national implementation, evolving technical standards, and so on.
Akash, thank you. And there's certainly, your points certainly echo with what we're seeing in our work at AFME with our members. Now, I will return to you for a follow-up question in just a moment, Akash. But before I do, I'd like to invite our audience this morning to submit Q&A if you would like our panelists to address some of your questions. We're going to save some time at the end for Q&A. So if you'd like to submit a question for our panel to consider and discuss and review, please do drop them into the chat box. So Akash, I hope you've had a moment to catch your breath after an excellent overview there. Now, my follow-up question, you've spoken about the sort of operational technicalities, the lack of clarity in some areas, which firms will need to operationalize the requirements. I think I've got a related question for you on timing. So I think my question would be, how prepared are you? And I think how prepared our industry, this is financial and non-financial sort of entities, how prepared are we to comply with the requirements of the EU AML package? What do you think some of those biggest challenges to implementation are going to be?
Thanks, Louise. So I think let me start with preparedness, and I'll start with Deutsche Bank's perspective. So at Deutsche Bank, we think we are relatively advanced in our preparation for the upcoming regulation. We are very much into the design and implementation of the requirements, although we recognize some of the areas of the regulation are not yet fully clear. We have set up a group-wide EU AML program for Deutsche Bank as a whole, covering all the business units. And we have included within the same program all the AML capabilities, right? So whether it's KYC, transaction monitoring, SAR filing, regulatory reporting, screening, we are covering all the areas that impact AML within the single program. Having the single central program is allowing us to build solutions that can be used across the bank. And examples there are not just about interpretation of the regulatory requirement, but some of the technology solutions that we are building. We plan to connect with the various systems and platforms across all the business lines, so we can get some scale efficiencies. If I go into more specifics on where we stand today, we have assessed the regulatory requirements and have developed now multiple drafts of the AMLR aligned policy, which is driven obviously by our second line. We have prioritized design and implementation of some of the most impactful and large changes. One big example of a large change in the regulation for us is changes in how beneficial ownership assessment works. And as we go through these requirements for AMLR, design the solutions, we are also implementing opportunities to deliver strategic target state solution that can exist for the next decade or so. So for us, it's not just about complying to the requirements of the law, but this we see as an opportunity to make the infrastructure, the processes for the next 1 to 2 decades. Now, clearly, that's good progress, but there are some challenges in the implementation. The first one is just the scale and complexity of the transformation. AMLR impacts all areas of anti-money laundering, the ones I mentioned just now. Granted, not all changes are massive in all areas, and not all changes are equally complex, but everything requires changes to policies, to procedures, to technology solutions, to data model, to operational processes. So you have to work through all those areas in a large institution like Deutsche Bank to ensure that all those changes work perfectly. The second area is specific to a few specific AMLR requirements, which are related to operational readiness and data collection. I'll take 2 examples. The first one is AMLR introduces new mandatory data points and tighter verification of UBOs, ultimate beneficial owners, and SMOs, which is a new concept for senior managing officials that AMLR introduces, which are relevant to the beneficial ownership topic. Now, this would be operationally challenging, especially for global banks that operate also in non-EU locations. So that's one challenge. The second example I'd give is the uplift of the high-risk clients. So AMLR obviously applies from July 2027, and existing high-risk clients need to be uplifted within 1 year, so by July 2028. Now, this sounds fine on paper because typically the high-risk file review cycle is 1 year. But the duration, periodic review duration, especially in the corporate institutional client space, tends to be 4 to 5 months, so from start to finish. Therefore, if a high-risk client whose KYC is in flight in July 2027, therefore will be completed to existing standards, will therefore need to be uplifted again to start in the next few months, such that it has to be completed before July 2028. And now this has an impact on the experience to the client and will also require additional capacity from our operations team. Probably I'll end my answer with probably the third challenge, and I mentioned a couple of times now, is the full clarity on the requirements of not all RTSs and guidelines being final as yet. Now, this does create a bit of a moving target for large institutions which have longer cycle times for implementation to embed changes in their entire technology and operations infrastructure.
Akash, thank you. And I think you very clearly articulate some of the sort of operational challenges and timing pressures. Carsten, I'd like to turn to you next and ask you your thoughts or views on any particular concepts in the package where market practice today is perhaps likely to be most challenged by the obligations and requirements of the new framework.
Yeah, sure. And first of all, good morning, Luis. Good morning, all. And thank you to AFME for inviting me to this panel. So let me start with a remark before answering the question. So from my perspective, the EU AML package is not just another regulatory change. It's a real shift in how we organize financial crime prevention in Europe. So the key question for banks is not if things will change, but where our current practices will no longer be enough. Let me highlight 4 key areas where I see the biggest challenges. So first, of course, the move to a single rule book. So as we all know, in the past, Akash also mentioned it, EU rules were implemented differently across countries, and banks had flexibility to adapt locally. So now, with the upcoming EU regulation, rules will apply much more consistently across the EU. The challenge is that many banks still operate with different local setups, but going forward, as we all know, we will need more harmonized processes on the one hand, and also more centralized control frameworks. So, and this is not just a policy update. As we can all imagine, it's a fundamental change to the operating models of our bank. Second challenge I would like to highlight is AMLR as the new European AML authority. So AMLR will bring more coordination across supervisors and more consistent expectations. In the past, so we as banks, we had to manage different regulators with different views. So in the future, we need to show a strong and consistent framework everywhere. And of course, we also should expect more comparison between banks. And this will definitely increase the pressure in banks to be aligned across all jurisdictions. Third challenge from my perspective is CDD, so customer due diligence and KYC. So as we can see from the upcoming regulation, the new framework clearly pushes us towards more ongoing and dynamic monitoring. So today, many processes in our banks are still based on fixed review cycles for low, medium, high-risk customers and are not fully connected. In the future, the expectation is that KYC needs to be more continuous, so more in the direction of a perpetual KYC, and monitoring needs not only to cover transactions, but the full client relationship. And this will definitely require a better integration of data and, of course, more advanced systems for monitoring clients. Also, this, for many institutions, is really a shift, a significant shift from how things work today. The last challenge I would like to touch on is data and effectiveness. So, or in the future, let's say supervisors will not only look at whether control exists, as they've done it in the past, but they will also look at whether these controls actually work in practice. So there will be much more focus, at least from my view, on strong links between risk, controls, and outcomes. So in the past, our AML frameworks were much focused on policies and procedures. Now, the clear expectation from AMLR, as we also heard it last week on the AMLR conference, is outcome-based and data-driven. So this means that we need better data governance, stronger analytics, and of course, a clear management accountability. In my view, this data challenge, let's say, is one of the most challenging areas. Thank you.
Thank you, Carsten. And I think very interesting to see some common challenges across the banks on the panel this morning, the focus on processes and systems. And I think this sort of paradigm shift to the role of data and data expectations. So given the sort of the new framework and implementing the regulation and the subsequent rules, I wonder, and I have a question for Goetz here. I wonder, to what extent can technology help industry, obliged entities, those within scope, as well as those under sort of NCA supervision? How can technology help organizations and institutions meet the requirements and obligations of the regulation?
Luis, both Akash and Carsten mentioned the priority of AMLA to use technology to get ahead of the criminals and prevent money laundering. So if we look at this ambition stated by AMLA, especially in view of more data-driven supervision and application of the most modern analytical tools, and Bruna Chego referred to them, I think, as supervisory tech. So we are not talking rec tech, but we are talking supervisory tech. Tech and data is absolutely essential and crucial to master the new requirements. So from my practical experience, let me give you two examples on that, and Akash already alluded to that. So I see from the gap analysis and the implementation projects we join that an average bank needs like 30 to 50 more data points relating especially to more granular information requirements. Akash mentioned the UBOs where you need more data, and on customers, and especially also on the purpose of the business relationship and the use of products. So you have much more data which you need to capture, you need to collect, and you absolutely need to be tech ready and system ready to collect those data and to process it. It is without alternative, and Carsten mentioned it, to strengthen the IT infrastructure and the data households. And secondly, that I guess it neatly fits into what Akash said, like beyond data, you need the most modern technical approaches. For example, in order to efficiently determine the beneficial owner, you don't want to have someone sit there and manually look at the company's house registers. You need to have a smart solution that reads through the company house registers and already starts building these ownership trees. Of course, there will be a human quality assurance on top and the determination, but you don't want to have the groundwork done by humans because it will not be efficient. You need to have that done by technology and AI and all that, and the openness of the registers enable for such solutions. So tech is absolutely in the center of all that.
Good, thank you very much. And I know we've already covered the expectations and some of the challenges around group-wide requirements. They're certainly one of the sort of most significant or consequential themes for firms operating within Europe and internationally in particular. So I think if we think about the sort of biggest practical tensions that firms see between group standards, local requirements, and then perhaps introducing the element of data sharing constraints. Carsten, what would your thoughts be on that question?
I would think that we all know that in practice for international firms, the key challenge is not the regulation itself, it's how to implement it across different jurisdictions where a bank has branches, subsidiaries, and so on. So in simple terms, what we are currently trying to do is three things at the same time. Apply consistent global standards, comply with regulatory expectations, and manage data with legal limits. So these three things do not always fit together easily. The first tension I see is between global consistency and local expectations. So the EU AML regulation aims to harmonize rules across Europe, but in in reality, at least to my expectation, national supervisors will still play a strong role, and interpretation can differ. So, for example, also in the future, at least in my view, we will see different expectations on suspicious activity reporting, on customer due diligence, or on some supervisory focus areas. So, but here, even small differences in these national jurisdictions will create complexity for international banks. So at group level, we face a choice. Either we apply one strict global standard, or we will allow local deviations. Both options, as you can imagine, have downsides. So higher costs or higher complexity. And this tension, from my perspective, will remain in the near term. So even with AMLR playing a stronger coordinating role here. So the second tension I see is about our operating models. So to manage financial crime risks effectively, we need central policies, standardized processes, and integrated systems. But local regulations, which we will still face, still requires local accountability and local decision making. So in practice, most banks, most firms will move to a hybrid model, global standards, but a local implementation. And yeah, finally, and it's again for me the most important tension I see is data. So as also Götz said, so effective AML today depends on sharing information across entities, understanding client relationships globally, and connecting transactions across borders. So at the same time, we face data protection requirements, limits on cross-border data transfer, and fragmented data landscapes. So we have a clear paradox here. To manage risk well, we need more data sharing, but in practice, it's still restricted. Of course, the new EU framework, it recognizes this challenge and aims to improve cross-border cooperation and information sharing. But for firms, this remains one of the biggest practical barriers to effective implementation, because this problem of solving data restriction is still not clear from my perspective. Thank you.
Carsten, thank you. And perhaps Akash, anything that you might add from your perspective?
Yeah, I think so. Look, I think this probably is one of the most complex and consequential areas in the AML package, right? And I'll probably echo all the thoughts that Carsten just shared. The first tension is clearly between strong group-wide expectations versus local legal constraints. Right? So the AMLR, particularly RTSs on group-wide requirements, sets a very clear expectation that parent institutions should ensure consistent standards across the group and data sharing, including customer and transaction data. Now, at a conceptual level, that is logical. It strengthens the overall financial crime framework. But in practice, we operate in jurisdictions with local protection laws, banking secrecy requirements, local restrictions on data sharing, and so on. So the challenge is, how do you meet this group-wide expectation without breaching any of the local legal constraints? And you know, as Deutsche Bank, we are working through that. Again, the second one, I think, again, Carsten mentioned, is the central standardization versus local risk ownership. So again, AMLR is pushing for central governance, more consistent group-wide risk assessment. At the same time, there are expectations on granular, entity-level, business-wide risk assessment. So for a large organization like us, it creates a structural question. How do you optimize for global consistency, but allow local relevance and regulatory alignment? Now, in reality, we understand we have to do both, but that's where the complexity comes in. And the third one, which I won't say is a tension, but I would probably mention this to this group. is the requirement that what we term as holistic client view. So, and I'm going to be slightly more technical here. So Article 16.3 of the EU AMLR states a requirement that obliged entities within a group should exchange information when it's relevant for customer due diligence and AML risk management. And then further, Article 26.1 of AMLR states that where a client is a client of multiple entities within a group, they shall take into account information relating to those other business relationships as well. Now, in practice, this mandates the need to make financial crime relevant information available across the entities of the bank. You can imagine for a bank like Deutsche, spanning across retail, corporate, wealth, asset management, investment banking, multiple systems across the business line, this can be very complex. But we have been working on this for the last few months, and we think we have a design now to address this requirement. So we feel confident we'll be able to deliver it.
Akash, thank you. And I think a really sort of a helpful reminder of some of the tensions within some of the sort of primary legislation as well here, and how you move to operationalizing some of those requirements. So we have had a couple of questions come in through the Q&A chat box. If you would like to submit your question, we'd like to remind the audience to do so, and we'll save some time at the end. I think as we move towards the end of our discussion this morning, we had a question for all of the panelists. And I think really we'd be very interested to know, and hopefully this will help the audience as well, if you were a chief compliance officer or a program sponsor leaving the webinar this morning, what would your top 3 takeaways or top 3 things to consider and take forward be? What should firms and teams in sort of in the industry be taking away and focusing on for the next sort of 90 days and beyond? Perhaps if I turn to Goetz, given your sort of view across different institutions and organizations, what would your top 3 takeaways or actions be?
Luis, and perhaps the benefit of inviting me is that I talk to many compliance officers and see, although there's a heterogeneous landscape in preparedness, like 3 big topics that need to be addressed. First is, and I guess it echoes what Akash and Carsten said, like data dimension and tech readiness. Because if you have a very simple ask to your IT department to have 20 new data fields which you need to collect new data, they might tell you like pull a number and line up and come back next year, because we are tied to release cycles, we have other things to do. So you have this interconnectedness with release cycles of main business software. You have restrictedness in availability of data experts. So that's first to involve first line and IT to see whether you get your data collected and to get it into some systems where you need that. Second thing, and I guess Akash referred to that, which is heavy lifting for the institutions, is the new determination of the beneficial owners. So either you have a smart tool yourself to read the company registers, to have these new control and ownership approach, and which both need to be assessed, and or look out for a reliable data provider, which is a reliable source and eligible for providing such data in order to buy it from there. But to get that on your list very on the top. And the last thing is where we see transparency is absolutely crucial, is with regards to the data actualization of existing customers in 1 year or in 5 years, to see like what quantity of or what number of customers comes in what time bucket to be actualized on that new level, or to lift it up, as Akash said, to this new level, to just avoid that you have peaks where you have not the resources, try to flatten that. So I guess those from my experience are the 3 big points we see.
Thank you, Goetz. And Carsten, what are the top 3 actions you think firms or those leading programs or compliance teams should be focused on?
Actually, my answer would go in the same direction as Götz has already stated. So I think my 3 priorities are clearly understand your gaps. So I think this is explaining, at least from my point of view. Then fix your data foundation and set up a strong governance. So let me skip the first priority and go directly to the second one. So focus on data. So as we have heard today, so the new framework requires more data, better data quality, and more consistent data across entities. So we have already seen increasing expectation here, for example, through AMLR's EU-wide data collection exercise, which was a real challenge also for our bank. If you have not already done so, in the next 90 days, I think you should clearly identify critical data gaps, improve data quality controls, and align definitions across the group. Then my third priority, as I said, is set up a strong governance and execution. So the new AML regulation, it's not just a regulatory change, as I have already stated initially. It's a large transformation program. So, and from my point of view, successful firms will need clear ownership and governance within this implementation project, defined milestones, and close coordination and collaboration across all functions of the bank. So we see in practice that a lot of banks have already implemented structured programs with multiple work streams and strong steering. So if you have not already done so in the next 90 days, this means you should definitely define a program setup, assign clear responsibilities, and agree on realistic timelines, prioritize the most important implementation steps, and so on. So in short, so my 3 priorities are understand your gaps, fix your data foundation, and set up a strong governance. With that, the program will become much more manageable. Thank you.
Carsten, thank you. Akash, what might you add as your top 3?
Thanks, Louise. I mean, the risk of going last is that all the points are already
Of
covered.
course.
But let me try to add to the points that my fellow panelists stated. So the first one I'd say is do not wait for full regulatory clarity before acting meaningfully. And when I say acting meaningfully, it's not just gap analysis, right? We need to move beyond the gap analysis. For the attendees in this webinar who are from the banks, you already likely have a very robust framework for AML. Therefore, you need to start to work on redesigning the policy, initiating the business requirement, start to work on the design and also starting to build it. For areas which are unclear, you need to make informed assumptions. So the mindset needs to shift. If you have this mindset, wait for final groups to design with assumptions and adapt as clarity evolves, right? So that's the first thing. Second one, again, I think Götz mentioned it, make beneficial ownership as a top priority. It is one of the bigger changes coming through the AMLR regulation, but don't just treat this as a compliance topic, but maybe a transformation pillar. There is an opportunity to potentially use AI for collecting beneficial ownership data so that it can be used to do the beneficial ownership assessment. So that would be the second thing I would say. And third is, and this is our experience from past such programs. This is not just about, don't just plan for technology and process changes, equally start to plan for operational readiness. So this needs to include things like what would be the go live plan look like, potentially trying to avoid overnight going live before the night of the 10th of July and everything is a big bang. Also thinking about how would the high-risk client uplift look like, which needs to complete within 1 year. topics like training, communication within the organization, communication with the clients, all of those need to be taken into account when the go live is thought through. And if I may add a fourth one, which I think I've stated now probably a couple of times, use AMLR as a catalyst for delivering strategic opportunities rather than just a regulatory compliance topic. Use it to review your platform architecture, assess opportunities for AI and automation as you deliver them, and enhance the data model, which is the basis for all the changes that we make.
Akash, I think you conclude on a great point. I think many of our members and industry have been sort of inundated with the requirements of the package, quite a compressed implementation time. And really, as and where you can find the opportunity, you will effectively end up with, streamlined, more efficient approaches and strategies to your whole sort of AML program. So I think we've had some excellent views from the panel this morning. And I think we've certainly had some alignment in what the common challenges are. And I think that really does demonstrate that there are key areas of the package which are certainly sort of challenging across the sector for exactly the same reasons. And I think it's been great to have an opportunity to talk through what some of those challenges are and how firms and sort of wider market participants might look to sort of remediate some of those sort of key concerns. We have saved some time for some questions at the end of the discussion. I can see you've had a few come into the chat. You still have time to drop a few more in. But perhaps if I go to questions in the chat, I think a nice easy question to begin with. And one of the attendees has asked, is data quality ultimately the biggest challenge for AMLR implementation? Akash, perhaps I might turn to you, as I know you've said a lot about data this morning.
Well, look, I think data quality is not just a challenge, it's an opportunity, right? At the end of the day, financial crime prevention is about having high quality data, and it is about analyzing that high quality data. That's always been the case, right? This is not new that AMLR introduces. What AMLR does do is make the expectations on what data institutions need to collect more clear, less ambiguous. So I do expect, yes, it is a challenge. Data collection, analyzing the data, having data up to high quality standard, it is a challenge. But this is not something I would say newly introduced just because of MLR. I think MLR helps move towards this goal. And remains to be seen, how institutions move towards it and what success looks like here.
Akash, thank you. And we have another question. So this question asks the panel regarding the future state supervisory framework. And the attendee has asked us, while the AMLR aims to reduce fragmentation through the single rulebook and the creation of AMLR, do you see the emerging supervisory framework as genuinely simplifying oversight, or are we moving towards a more complex hybrid model with overlaps or potential overlaps between AMLR and NCAs? Goetz, I might put that question to you.
Yes, I'm happy to take it. And of course, as per now, we cannot fully rule out that there might be such risk, but I would be optimistic. And why would I be optimistic? So for those of us who were already in business in 2014, when ECB took over the microprudential supervision from national competent authorities, of course, I guess there was the same fear of, do we have ECB also issuing RTSs, ETSs, and do we have the national competent authorities still looking at that time own funds, liquidity, and all the microprudential risk dimensions? I guess it turned out quite well to have no overlaps or very limited overlaps. And if there are overlaps, they are very precisely defined between ECB and national competent authorities. And I would be optimistic that same could happen here between AMLA as the central authority, and it is also the supervisor of the supervisors, so not forget that, so that there are perhaps less overlaps.
Thank you.
If I may add, Louise, if that's fine, I think it's important to understand what are the specific areas where local divergence could exist.
Correct. Akash, very good point. Yeah.
So I think in my view, there are three big areas, right? So firstly, in the AMLR regulation, there are empowering clauses, as it's called. So examples of that are, your PEP definition could be defined slightly differently by a member state. There are examples like cash transaction reporting thresholds, which is 10,000 euro in AMLR, could be different if member state wants that. So I think, and there are a couple of probably other examples which I don't remember, but that, that's one area where divergence could exist, right? I think the second area where divergence could exist is the national risk assessments, right? So member states could come up with higher risk situations. They could come up with different enforcement priorities because each country could have its own enforcement priorities, which then needs to embed into the implementation that institutions are doing for that specific country. And I think the third area where divergence could come is kind of the recognized areas where national variations do exist. So you have the national FIU reporting frameworks. Yeah? You have national registries. You have BO registry, UBO registry, which are member state specific. So I think that's the third area where these. So I think to go back, right, we need to understand what are these different areas where these divergences could exist. I think if I look at the first point, empowering clauses, I believe that is a very small subset of a large AMLR regulation. So while we're still waiting to hear from member states if they want to utilize those divergences or not, but at least on the AMLR regulation, that is limited. It's not that the divergences could be massive here. So I just want to add that to the.
I think that's a very relevant point. Thank you, Akash. And thank you both for answering that Q&A. We have another one that's come in that I think I might direct to you, Carsten, if you're happy. So the question that's come in order to identify a natural person's risk exposure at a bank, the aim is to move towards a single client ownership and view approach. Do you think EU regulation is sufficient to, and the question is override, but I think we mean sort of integrate or recognise national data protection considerations at least within the EU, given it's a directly applicable regulation, where are limits still seen specifically regarding customer data outside Europe? Now, we know this is a common challenge for those looking at it under the EU AML package. Carsten, what might your thoughts be here?
Yeah, it's a very good question. And actually, it's one of the questions which is occupying or keeping us busy the most at the moment. Because, yes, of course, as I have already mentioned previously, we have this new EU regulation with stipulations, let's say, allowing this kind of data sharing. But as you might have already seen from responses to the consultation paper from banks associations, so I think the current view of banks association is that these empowerments, let's say, which we see in the regulation, are not enough, are not clearly enough defined. Even if I look at the drafts of the RTS, and that there's still room, let's say, for improvement, for more clarity, to override all this national data protection concerns. So yeah, it's a very good question and short answer. So from my perspective, at least, I think so. What we currently see in the regulation is not yet enough to get rid of all obstacles here. Yeah.
Great, Carsten, thank you very much for that. I think we have time for one final question, and this is on the sort of internal structure of your compliance function. So perhaps I might go to Akash next, if you're happy to take this question. So the question asks, how do you envision the organisational placement of the compliance manager and compliance officer roles? Should these be centralised within a group compliance function in the second line or embedded within business units in the first line? And I'm sure the answer will depend on the size and scale and complexity of your individual organisation. But Akash, any thoughts from you?
Yeah, happy to share my thoughts, and Carsten and Goetz can come in, right? So I don't think the principle about having an independent second line changes, right? So I think that is the starting principle that I would keep. I think the question is more relevant to within Europe, what is the level of standardization that you can have across the different compliance teams, within individual countries. I think that it's more a regional angle rather than a first line, second line angle, in my view. There are potentially opportunities to look at areas where, things can be consolidated or standardized across Europe, given AMLR is coming. But I don't necessarily see the role of first line as the risk owner and second line as, providing the guidelines, the framework, and ensuring that first line is keeping true to its belief. That does not change in my view.
Good. Any thoughts on that question? And thank you, Akash.
Yeah, of course, we saw from the past approaches where you had a more centralized AML framework and also governance, and also there were others who had a more decentralized, where more responsibility was placed to local MLROs. So fully agreeing to what Akash said, like I guess there is, from reading between the lines, there might be a tendency to a more central organization and standardization of AML prevention, CTF, and targeted financial sanctions in groups. Of course, taking into consideration what Akash said, and what also Carsten said, you have this ambiguity between like reflecting the local requirements and of course giving group requirements, and we have a fallback as we always use it, which is then the stricter of approach. You compare the group requirement to the local one and use the stricter of locally. And so from my perception currently, there is, if the parent entity is domiciled in the EU, there's a tendency for a quite standardized and central direction of AML prevention.
Good. Thank you very much. And we're almost at time this morning. I'm sure you'll all agree that's been an excellent discussion and very insightful. I'd like to thank all of our speakers, our esteemed panel. Thank you for joining us this morning and for being so willing to share views and address Q&A from the audience. I'd like to thank Frankfurt Mind Finance and Andreas for introducing the session and inviting us to collaborate on this topic today. We think this has been a great discussion. I believe a recording will be available. We will be in Frankfurt in November for the AFME AML conference that takes place on the 4th of November, and we will be collaborating alongside Frankfurt Mind Finance as an event partner for the event. I'm sure a lot will happen between now and then, but thank you all for making the time available to join us this morning. And thank you to my colleagues on the panel and to Andreas. Thank you.
Thank you very much.
Thank you.
Have a good day.
Thank you, Lee. Thank you, everybody.